Hello friends, let us understand some more basic concepts of income tax law. Now, one of the basic concept in this income tax law is charging of income tax. According to section 4 of the Income Tax Act 1961, this section, it focuses on charging of the income tax. This section 4 of Income Tax Act 1961 is called the charging section, which provides that tax shall be charged at the rates prescribed for the year by the Annual Finance Act or Income Tax Act 1961 or both. So, according to this section 4, which is also called as charging section of Income Tax Act 1961, tax can be charged only at the prescribed rates. That means these rates are pre-stipulated. They are what we can say, priorly stated, priorly announced. So these rates are prescribed for a particular financial year by the Annual Finance Act or Income Tax Act or even both. Now this charge is upon every person specified under section 2 subsection 31. Who can be charged under Income Tax Act according to section 4? So every person who is specified under section 231, that is section 2 subsection 31, every person included in that or mentioned in that can be charged under the Income Tax Act for income tax. Now tax is chargeable on the total income earned during the previous year and not the assessment year. Now what does this mean? Tax is chargeable, that is, tax is to be calculated. Tax will be calculated on the total income. Means not just the part of income, the total income which is earned during the previous year. That means not the current year but previous year, the year before this current year, right? And this tax is not chargeable on the total income of assessment year is not taken into consideration. Assessment year is not the current year for this matter, for calculating the tax. So for calculating the tax, the total income of previous year is taken into consideration. And what is previous year? The year which is preceded by the current year, right? So there are certain exceptions also given under section 172, section 174, section 174A, section 175 and section 176. There are certain exceptions to this particular rule. Then tax shall be levied in accordance with and subject to what is contained in the Act. Now tax is to be levied, that means charged or calculated or imposed in accordance with, means according to the Act and whatever is contained in the Act or rules in the Act, whatever is given in the Act, subject to certain, we can say, variations or certain exceptions, right, contained in the Act. Levying of income tax. Income tax is levied on the total income of the previous year of every person. And a person here includes an individual, that is a human being, and HUF, that is Hindu Undivided Family, association of persons, that is AOP, body of individuals, that is group of persons, again body of individuals, BOI, and a firm, that is partnership firm, and a company registered under the Companies Act 1956, and any artificial judicial person, that means any organization that is registered under a particular statutory legislation can be called as artificial judicial person on which levy of income tax can be calculated or charged. Now certain important terms under this Act are income, assessee, assessment year, previous year, residential status, gross total income, deductions and total incomes. Total income. Let us understand them in detail. Income under section 2, subsection 24, it means certain monetary returns, that is returns or earnings in monetary terms or in terms of money. Periodically received, that means received say monthly, quarterly or annually from some definite source. That is, we should be able to tap the origin of the income that is earned or earning that is done. So it is, in simple terms, it is an earning or a continuing income from any business or firm, etc. from a definite source. We should be able to tap the source of any earning. Only then we can call it as income under section 224 of Income Tax Act. Otherwise, we cannot call it as income under this act. That means it includes any income in the cash, hard cash form, any income in kind, that is income in non-cash form, that is any commodity or gifts received, that is say you can say perks, perquisites, any allowances, right? All these come under income in kind. Any gifts, bonuses received, etc. Thereafter, assessee as per section 2, subsection 7 under the act is a person liable to pay any tax or any other sum of money under this act. That means every person who is assessable in respect of income or loss of another person, or who is deemed to be an assessee, or who is deemed to be assessee in default. Any person who is liable to pay tax, that means who is responsible to pay any particular sum of money under this act, who is assessable under this act for his or her income or for loss of any other person. Under this act, not only direct assessee or proper particular assessee, but a deemed assessee concept is also there. So any person at times can be called as a deemed assessee, even if he is not the real assessee, right, under the act. We will understand these things in detail in further discussions. Then person, according to section 2, subsection 31, an assessee is a person by whom any tax is payable under the act. We have seen this, that it includes individual, firm, HUF, company, AOP, BOI, any artificial judicial person and any local authority as well, which is registered under any legislature. Then income tax liability of any person, we can calculate it, compute it as per following steps. So firstly, we will have to decide the residential status of that person. So residential status of a person will decide the income tax liability. For example, if a person is resident in India, his residential status is called as he is Indian. It will be treated as he is a Indian person. But at times people go abroad to foreign countries, stay there for certain period or few months. In that case, they may be called as non-resident Indians according to particular rules given for the residential status, right? So person may be resident or ordinarily resident or non-resident according to the rules given. Then previous year is the year in which income is earned. Previous year कौन सा year है? जिस year में ये income earn किया गया है, कमाया गया है, that is called as previous year. Then assessment year is the year in which this income is taxed or assessed. Assessment year किसको कहेंगे? जिस year में इस income के ऊपर tax calculate होगा और charge होगा. Right? So previous year and assessment year are two different concepts. पहले previous year आएगा, उसके तुरंत बाद आता है assessment year. Right? So assessment year consists of 12 months, which commences from first day of April immediately after the previous year. So previous year अगर end होता है 31st March 2026 को, तो assessment year शुरू होगा 1st April 2026 को, right? So income earned in the previous year is taxed in the assessment year. Now, what is assessment? Assessment is a process of determining the correctness of income of an assessee and of assessing the amount of tax payable by him and the procedure for imposing the tax liability. So, assessment क्या है? It is a process. Process means there are certain steps in it. Prescribed steps which have to be followed in a order. So, it is a process of determining correctness of income. Whether the total income calculated of any assessee under the act is correct or not. This comes under the process of assessment. And calculating the amount of tax thereupon. So whenever we calculate the total income, we'll have to check for its correctness. We'll have to verify its correctness, whether it is calculated correctly or not. And then we can calculate the amount of tax on it. And the procedure involved in this particular act is called, we can say procedure involved in this particular activity is called as assessment, right? Now we have seen the assessment year and previous year concepts. Let us understand them in detail. Under section 2 subsection 9 of Income Tax Act, assessment year means the year commencing on 1st day of April every year ending on 31st March of next year. If example the current year say is if the current year going on is 26-27, the assessment year going on is 26-27. The assessment year has started on 1st April 26. It is going to end in the next year 31st March. It is going to end on 31st March of next year, that is in 2027. So assessment year is 26-27, right? And current year for this matter will be, what will be the current year in this matter? Current assessment year will be 26-27. Previous year we will calculate it just before that. So according to section 3 under the act, previous year means the financial year immediately preceding the assessment year. So previous year, again we can call it, assessment year has to be of 12 months mostly, but over here we can say previous year may be somewhat extended or contracted, we can say. So previous year is the financial period immediately preceding the assessment year. So if our assessment year has started on 1st April 2026, the previous year has ended on 31st March 26, right? So 12 months before 1st April 26 are previous year, and 12 months from 1st April 26 is assessment year. So the year in which income is earned is called previous year, and year in which it is taxed is called assessment year. Now there are certain exceptions. The previous year in case of newly started business. For example, the business was started say in July 2025. If the business has started in July 2025, that means what will be the period of previous year in this case? In this case we can calculate 6 months plus the period of 3 months. That means 6 months from July to December 25, these are 6 months, and 3 months, that is January to March 2026. So this is the period of 9 months. In this case we can see that the previous year is not of 12 months, rather it is less, and it is only of 9 months. But at times in case of say company type of organization, company form of organization, at times if at all this company has been registered say in January 25, if a company is registered in January 25, now for few months, like 1 or 2 months, the company will not be required to file any return of income tax, because not necessary there has been any business during these initial first 2-3 months. So it can very well postpone the act of calculating this income tax, and hence the period in this case will be, again let us understand this example. A company has started its business say in the month of January. So January 25 it has started the business. So whole year of January, that is 12 months, and 3 months of 2026, that is January 26 to March 26. In this case 12 plus 3, that is in this case the previous year of this company will be counted as 15 months. So previous year can be of more duration, but not more than 18 months. Here again there is some barrier, that is not more than 18 months. Usually previous year cannot extend 18 months, right? In this case of the company example that we took, it was of 15 months. So this can be verified by calculating the correct period, because if the period calculated is wrong, the amount of income tax calculated will be again wrong. So we have to be careful while understanding these terms and applying them while calculating the total income and the tax thereupon. So these were certain other terms under Income Tax Act. Let us discuss some few more terms in our part 3 of basic concepts of Income Tax Act. All the images are taken from the internet only, for educational purposes only. Thank you for being with me.